this discussion about climate change. As all of you know, I think climate change has become one of the top priority global agendas, and it has been intensively discussed at COP27, for example, is currently going on in Sharm el-Sheikh, G7, G20, as well as all the standard setting bodies in the financial sector as well. So I hope that this discussion will be a good discussion, showcasing perhaps the work of the IAIS, also taking stock of what is happening in the private sector. And I also believe that exchange of views among the regulators and the private sector will benefit both sides to further promote our efforts to address climate change. So with that, let me first kick off the discussions, perhaps starting with the polling question that we have. If you can present the questions. And provide an answer of what you think about this question. The NGFS has set out 4 scenarios for addressing risk from climate change. Which one do you believe is most likely? So whether it's disorderly, too little, too late, or orderly, or hothouse world. And this is a very fundamental question about how everyone thinks that our efforts to address or tackle climate change is progressing. And I think it will be interesting to see how the audience today thinks about this question. So please. Okay. Interesting results here.
We're all going to die.
So too little, too late. I think that's the majority, actually. Well, it's still moving a bit, I would say. So it's now at 50%, around 50%. Disorderly, well, this is that we will probably meet climate goals, but we'll have some disruptions along the way. And the hothouse word is that we are not doing basically enough and the emissions will rise. And orderly is at 8%. So this is a very interesting, I think, assessment of the situation. So let me take from our panelists a quick response on what they think about this answer. And let me start off with Ricardo Lara, who's the commissioner for the California Department of Insurance, who has kindly joined us for this time. What do you think?
Thank you. It's great to be here. I didn't know we were such doom and gloom. But I think I'm forever hopeful. And we have seen governments and states in the United States start to work towards lessening their footprint. But I think there's much more that can be done. I kind of more of agree with it's a little bit more disorderly because we still lack the data and the instruments to collect that data to be able to notify how we're measuring progress. And every time there's another initiative or another goal that is published out there after a COP, it kind of sends all this kind of, okay, how are we going to measure that? What does success mean? And I don't think we know that yet in the financial sector, definitely in the insurance sector. And so I think we're a little bit more disorderly, but we're getting to where we want to go. I just, maybe because I'm an uncle, I don't want to be so doom and gloom for the next generation.
Okay, thank you very much, Commissioner, for your view. Let me also pose the same question to Daniel Wang. He is currently the chair for the IAIS Climate Risk Steering Group and executive director of the Insurance Department for the Monetary Authority of Singapore. So Daniel, what's your kind of response?
Yeah, thanks, Shigeru, and good afternoon, everyone. Pleasure to be here. I think I fully agree with the too little, too late that the majority of you voted. If you look at current commitments by governments, we are not going to meet the 1.5 degree that was agreed in Paris. In fact, we are now already headed for a 2.5, 2.8 degree world. And so this will have devastating consequences for the planet. So I think there's a lot of room to do a lot better by governments and the private sector.
Thank you. Thank you very much, Daniel. And let me turn to the panelists who have kindly joined us virtually today. Let me start off with Astrid. Astrid Yakel, the Chief Risk Officer for Egon. So Astrid, what do you think of the results of the polling question? If you can hear me well, I hope you can hear me well.
Yes, I can hear you well. Thank you. So the result of the polling question is in line with what I would have expected. So here at Egon, we at the moment also feel that we are, as a whole, as society as a whole, on a too little, too late track, unfortunately. We as Egon and as insurance industry and financial services industry are doing our best to change that. But at the same time, we also feel that a more concerted effort by governance across the world, globally, is required to get away from the too little, too late track.
Okay, thank you. Thank you very much, Astrid. And last, I would like to introduce Bill Marco, the Chair of Law, Regulation and Resilience Policies Working Group at the Insurance Development Forum. So Bill, what is your view on this question and answers? Oh, you may be muted.
I am unmuted.
Okay.
I am unmuted.
Now you're fine.
Yeah. I lost your audio a bit when you were doing the polling, but I take it it's the too little too late was the top of the polling response. And whether it was or not, I would say that's where I land on this question for a lot of reasons. Even going back 2 years ago, you might have said that we'll do too little too late. I think coming out of COP26 last year, there was a phenomenal kind of generation and greater momentum that I think might have changed that conclusion. But the events of this past year, clearly involving the war in Ukraine, what it's done on energy is just a huge adverse impact on the momentum that I think was gathering for change. I do think that it's becoming increasingly front of mind for many actors in the world. And so there's some optimism that's due from that. But this is a challenging problem, and we're late in the game, and it's going to be hard to be completely successful.
Okay, thanks very much, Bill, for your views. And let's move on this. And I think, given the results of the answers of the poll, I think the majority of people think that efforts are a little bit too late, too little, too late. But first, let us move on with what IAIS is doing in this regard. And maybe it will be good first to call on Daniel. And would you like to perhaps briefly update us on the work of IAIS in undertaking these climate risks?
Yeah, thanks, Shigeru. So let me preface my introductory remarks that something that we all know, but I think we all do need to be reminded of, right? Climate change is a global challenge and it requires concerted action and therefore demands a consistent global response. So the Climate Risk Steering Group at the IAIS, which I happen to chair, we are really striving to support our members in their climate change journey by enabling insurance supervisors to manage the risk posed by climate change on the global insurance sector and, of course, to your policyholders. So in the last year, the CRSG has undertaken a considerable amount of work falling into three main areas. So firstly, on standards. To reinforce the importance of incorporating climate change into insurers' business operations and risk management practices, the CRSG has and will continue to provide more guidance on supervisory expectations in this regard. So applicable insurance core principles guidance material will be developed to provide additional guidance as to how insurance supervisors should require insurers to incorporate climate-related risks into the day-to-day operations, such as risk management, such as governance. These materials from the IAIS will be consulted upon next year. Second, on scenario analysis, the CISG has been actively supporting our supervisors in developing capabilities to assess climate risk. So in the past year, we have gathered feedback and information from stakeholders to develop materials for a series of workshops. And I'm pleased to say that these capacity building workshops have benefited more than 200 insurance supervisors on a wide range of topics relating to scenario analysis. So from the basics like understanding the micro and macro prudential objectives of scenario analysis with regards to climate change, to more advanced discussion on technical design specifications. So as we continue to leverage on the existing work by, we also continue to leverage on existing work by NGFS, which was already mentioned, as well as the Sustainability Insurance Forum in this regard. So the CISG's next step, we will be putting out workshop materials and learning points into an application paper on climate scenario analysis. Finally, on data, supervisors and yourselves in the industry certainly face a lot of issues relating to data availability and quality. So by incorporating climate data elements in the IAIS global monitoring exercise, as you're well aware, the CISG hopes to provide a global baseline of climate risk data and pave the way for analysis of such data. So data from the 2022 GME will feature in the climate section of the upcoming Global Insurance Market Report, the GMA. And then in the coming year, I foresee the CISG will develop recommendations for GME 2023, and very importantly as well, to keep a close watch on the implementation of TCFD-aligned and ISSB-aligned reporting and disclosures. So in sum, these three areas will provide supervisors with the means to, number one, strengthen supervisory expectations, number two, assess climate readiness, and finally, quantify climate-related risks. So I hope that the CISG will continue to contribute more in this area. Thank you.
Okay, thank you very much, Daniel. I think that's a very good overview of what the IAIS has been doing on this very important issue. And let me now turn to other panelists. And I think the polling questions and answers provided a broad kind of view that we're doing a little bit too little or too late. And I would be interested in the panelists' views because we have seen a number of pessimistic assessments which coincides with the answers to the polling questions, that there's a pessimistic assessment of the ability of the public sector, of governments, to deliver policies that will help the world reach the Paris climate targets. And I would be interested in I think the audience would be interested in how does it look from the from the insurers about the impact of the current kind of progress that we are making, and if there are any tipping points. And I would also very much like to hear the Commissioner's view of what you think about these issues from your perspective as a Commissioner in California. So thank you. And let me start off then first by asking Bill on this. Thank you.
Thank you, Chiguro. Listen, the impact of where we are today, the impact of doing too little and doing it too late is profound on the insurance industry. It is on society and economies broadly, but given the insurer's role in the economy, it will have and is having a significant impact. In saying that, I think that the risk of financial distress to insurers from climate change, it exists for some, but insurers are pretty good at knowing what their exposure is. They reprice their products on a yearly basis around Nat Cat and weather-related losses. And so I think, yes, one has to focus a bit on that, but I would not put financial distress at a high point. But what you see happening, and we see it this year, we see it in the reinsurance renewal season that's underway right now, many companies pulling back from the market, some withdrawing from writing property cat completely. A number of people have done that. Others are pulling back. And this is even with prices going up in light of the losses. So the impact, in my view, on the insurance industry is that these increasing losses, the volatility, the frequency of extreme weather events, means insurers are going to be challenged more and more on the ability to provide products at prices that serve their customers. And if they're not able to do that, they risk becoming irrelevant. This is a time, these are risks that the insurance industry is made for, and hopefully will, and I think it is stepping up in many ways. But if it is so severe, they have no choice but pulling away from the marketplace, and that's a lose-lose situation. I also think, lastly, and we do see this, as progress is not made, as governments perhaps don't do what they do, people continue to look or begin to look to the insurance industry as the policymaker of last resort, that they should be taking steps to stop the use of thermal coal, whereas clearly governments, if they were doing things, have a very direct way to regulate what industries do what under what circumstances. But of course, we see it in many, many areas where it rebounds back to the industry and other parts of the financial world to try to drive behavior that people want to see, but that governments are not providing. So those are some of the dangers. I think, yes, we're at a tipping point. Sadly, we've already tipped over some points, but the situation is getting more severe, and we have further tipping points coming. So I'll stop there.
Okay, thank you, Bill. I think your answer is probably quite related to the topic of protection gaps, and I think further build on what your comments and perhaps on later on this in this session. But thank you very much for sharing your views. And let me ask Astrid about Bill's comment, perhaps in relation to how you see it in the private sector on the ground, for example, about what is happening with respect to government actions or the top tipping points that Bill has briefly mentioned about, and welcome your views on that.
Yeah, thank you. Yeah, maybe let me step back a little bit and also say a little bit about Egon, which I'm representing today. So we are an integrated financial services group and headquartered in the Netherlands. We do have insurance and asset management business. On the insurance side, our business is primarily in the life and pension space. So I can't comment as much on property and casualty related topics, even though, of course, in the context of climate change, this is very important. So you asked me about the impact of the fact that we are most likely on a too little, too late path, and the impact of policies not delivering an orderly transition. And one remark I would like to make in this context is that I don't think, given that we are at the IAIS conference today, I would like to highlight that from our perspective, the issue is not on the supervisory side. So in Europe, both EIOPA and the DNB, the Dutch central bank, have done a lot of work on linking climate risk into our prudential framework, the Solvency II risk-based framework, and making sure we assess climate risks appropriately in our own risk and solvency assessments, in also making sure that we report appropriately on climate risk. So these efforts are underway, and I would, of course, also like to thank the IAIS for the work that Daniel just gave an overview of. So coming back to the question, of course, it is a big issue for us, for everyone, if that we are on this 2.4 to 2.6 degree path rather than the 1.5 degree path that we want to be on. So from an insurer perspective, what this means for us is that we feel we need to act ourselves. And, you know, as you know, there are lots of initiatives going on. We, as Egon, are part of the Net Zero Owner Alliance, and together with other members do a lot of work to make sure that our asset portfolio contributes to the transition as a member of the Net Zero Asset Owner Alliance. But of course, climate risk, as I always say as Chief Risk Officer, it really affects everything. It's not only on our asset side, it's also on our liability side. Yes, as a life insurer, we are a little bit less impacted than the P&C insurers or reinsurers, but nonetheless, there will be impacts on mortality, there will be impacts on morbidity. So it is also important for us. And what we are aiming for is to really basically incorporate climate risk in all of our business processes, in all of our angles, in all angles of how we assess risk, price risk, deliver products to the market. But it's a big endeavor and takes time. We are trying our best to move as quickly as possible, but it's not that easy.
Okay, thank you very much, Astrid. Thank you for sharing what's happening at Egon as well as in the region in Europe as well. And I think that's very helpful for us to understand what is happening on the ground. So thank you very much for your comment. And let me finally turn to Commissioner Lara about what your views will be, hearing what the panelists have mentioned as well. Thank you.
I think it's important to also showcase that there are things that we could be doing now and that are proving to be successful either at the state or different country levels. Because we do know that the best way to combat climate change is to reduce emissions. And in California, we've done so, and additionally adding reductions to super pollutants, which are HFCs, black carbon, and methane. But we are already seeing, despite the reduction in emission efforts, that we need to move towards climate adaptation. And that means, how do we adapt to this new reality? And in California, as you all heard, we've had some of the most devastating wildfires that we've had in the history. And so what has that done to the insurance sector? One, it's quadrupled the cost of insurance. It's had some insurers trying to pull out of the housing market. And then as the regulator, you're trying to create that balance where you need to ensure that insurance companies are solvent, but that you also have an affordable product for people who are working towards rebuilding. And this, by the way, is affecting the entire state of California, not just specific areas. And so one of the strategies that we started working on was, how do we reduce the risk for everyone? So we want to keep insurers competing for their business, right? And the way we do that is by reducing the risk for everyone. So we went from no longer just having the discussion on what consumers can do in their individual property, but moving towards what can you do as a community to bring down the risk. And we engaged in a regulatory approach where we worked with insurers who, quite frankly, didn't want to leave the market, California is the largest insurance market in the US, fourth in the world, and it is still very profitable. But the fact is that these new climate intensified events are really challenging us to figure out how do we provide those reduction incentives. And so what we quickly moved towards was how do we incentivize consumers to do the right thing to harden their home against wildfires, floods, and extreme heat. Previous to my regulation, consumers would be asked by the insurer to spend thousands of dollars to harden their home without any benefit to their insurance policy or product. So we changed that. We said now in our new law and our new regulation that every insurance company has to provide discounts for homeowners that do the right thing, which is harden your home against fires. And not only that, but we included an approach in terms of community-wide mitigation. Because we know if the community then works together to bring down that risk, insurers are going to keep writing. So this is another example of where, we're looking at practical changes towards not only strengthening the insurance market, and we work with the insurers to ensure that the home hardening effects that were going to be implemented, we're actually going to reduce the risk given their expertise. And now we have a product in which we're actually incentivizing people by giving them discounts and, quite frankly, helping our low-income community folks that may not even have the money to harden their home, even if they want, now have an incentive to do the right thing, hopefully bringing down the risk for everybody and keeping insurance available and affordable in some of our most vulnerable communities throughout the state.
Thank you very much, Commissioner. I think that's a very worth a good point, and we'll probably build on your comments later on when we discuss protection gaps. So let me thank the panelists for their views, and let me move to the second polling question. So we are on the second point. We want to focus on the private sector, on governance and risk management processes, and this coincides with what Astrid has mentioned about how integrated climate risk is into the business lines of the insurers. So let us hear your views on this question. Okay. All right. So now it looks as half of the people think that it's still at an early stage of integration. But integrated, but further updates required is a bit behind. Totally integrated and not integrated is about the same at around a little bit below 10%. All right, so let me start off with Daniel. What do you think of these answers?
I'd like to thank everyone here for being so honest, actually. Because I think it's a pretty accurate and honest self-assessment, and I suspect that results between partially integrated and more work to be done. There's probably a geographical element to that, depending on whether you are situated in a country or region which has a lot of this kind of natural catastrophe perils, as well as the level of sophistication in your risk management techniques and the support you're getting in the community and your stakeholders in that. So I will quite agree with the response.
Okay, so you think it's a very honest and frank response. Commissioner Lara, what is your view?
I concur with David. I think it's absolutely right. We're still very early, and I even think, I would dare to say that in the US, we're still even more behind in terms of trying to catch up with what the rest of the world is working on. And so I agree with the assessment.
All right, thank you very much. And let me turn to Astrid. You mentioned about your efforts at Egon, but does this survey or does the answer match what's your views as well? Or let me...
Yes, it matches my view. So at Egon, I don't know whether we are integrated but further updates required or early stages, but we've definitely done work to integrate climate risk in our business processes, in our risk management framework, but it's not as completely integrated as I would like it to be in 2 or 3 years. We are doing qualitative climate risk analysis and assessments. We are doing quantitative assessments, but only on the asset side. What I'm really looking for is completely integrated scenario analysis where climate scenarios are also directly embedded in our mortality, morbidity assumptions. I know that this is, of course, more urgent for P&C insurers than for life insurer, but even for us, I think it's important to really integrate it everywhere. At the same time, I also feel that we need to move, and we can't wait to have the perfect framework before we do something. We don't want perfect to be the enemy of good and of making progress. So from that perspective, I feel we are on a good path, on a good trajectory, but there's always more that can be done and needs to be done.
Okay, thank you very much, Astrid. So let me now turn over to Bill and see what your view is on the response.
Yeah, I think the panelists have made very valid comments just now. I might have flipped those two top priorities in my own mind, maybe. But I guess to really go to the heart of it, undoubtedly we're at an early stage as climate has come on to the agenda of institutions, of regulators themselves, of the public generally. Has really accelerated over the last 5 years. Yes, you can go back 10 years, but we're at an early stage, I think, by any definition. But the real question is, have they made substantial progress on this? And I think that's where I would say, certainly the insurers and reinsurers that I have engagement with have very substantial processes in place. A lot more needs to be done and will be done, but there's a couple of points, and one of the related ones is P&C insurers in particular. Their core competence is measuring risk. It's what they do, and that's risk to themselves, risk to their clients and others. Again, these risks are evolving and need to be looked at. But I think where we're particularly in the early stages is in measuring, climate risk, but also carbon footprint of investment portfolios, of underwriting portfolios, and obviously a lot of activity is taking place there. I will say, and I think we'll get into it in the next questions to the panelists about, where are insurers in terms of their corporate governance and hardwiring a sensitivity to climate risk there. So I'll wait for our discussion right there. But I guess I would end by probably conceding or agreeing we're at an early stage, but that's not synonymous with, boy, we're nowhere. We're not really doing very much because I think the industry has been very, very active over the last several years. I think that'll increase and needs to, certainly. But I think both industry and regulators are going to continue to advance in this area.
Okay, thanks. Thank you very much, Bill, for sharing your views on this. And maybe we can do a little bit of a deep dive on the current polling question and your answers. And first, let me ask the Astrid and Bill on the private side about the practical steps. What practical steps are insurers taking to integrate climate risk into their governance and risk management processes? And how are they actually reflected in the 3 lines of defense? That's one thing that I think the audience would be interested in. Another would be perhaps do insurers encounter resistance to integrate these changes in their business or find that climate change related objectives may be in conflict with other strategic and financial goals of firms? And how do you or how do they, in terms of the industry, deal with these kind of questions, which might be a bit of a challenge in integrating climate risk into the private business. So let me start off with Astrid.
Yeah. So the way we go about it, we integrate climate risk in the way we do our business in multiple ways. So at a top level, sustainability is part of our purpose and strategy. And then within sustainability, climate change and managing and mitigating the impact of climate change is one of the focus areas. We have a group level sustainability team that lets our work on everything related to sustainability, including climate, and make sure that this is fed or that climate considerations are fed into business processes and business considerations. We do have sustainability boards in each of our local business units that link into our global sustainability board. In the second line in risk, we of course also do a lot of work to make sure that climate risk is appropriately covered. What we've done partly last year, partly this year, is to make sure that climate risk is really embedded in all relevant policies. So, for example, we've made sure that climate risk is embedded in our pricing policy. Of course, it's already in our risk taxonomy. It's always been, or for a longer time, it's been a consideration in our non-financial risk policies. So that is really the way in which we integrate climate risk in our considerations. And then a completely different topic, of course, is investments. And as I said earlier, on the investment side, we are a member of the Net Zero Asset Alliance, and from that perspective are very actively working on shifting our portfolio towards that objective, towards a net zero portfolio.
Okay, thank you very much for sharing your views, Astrid. And let me also turn to Bill and see what your views are on the questions that I just posed.
Certainly, thank you. I think like most issues that go to operational excellence, to culture, to vision of a company, what they stand for, what guides, what's their North Star, tone from the top is critical. And I know of a number of companies, the regulators, particularly as you engage with those that you regulate, will see variations, but I think one thing that is vitally important to success in this area is indeed what is the tone from the top, and how is that disseminated. It is also true that this needs to be, and I think, and I know in many, many cases, is a board level issue. It needs to be top of that agenda. Again, partly, as Astrid noted, so many operational parts of the company, this is relevant to, and as the board reviews where the company is, where it's going, it needs to give real consideration to the variety of issues that are there. How is it kind of hardwired into the company? Astrid noted in your question contains, it really needs to show up in all three lines of defenses. And again, I think you see within Insure, the underwriting side, claims handling, investments, all the operational parts, need to, and again, I think a lot of progress has been made in this area, more will be made, but having, climate risk as part of, the operational mandates and focus that is there. Clearly, with anything that's of this nature, Astrid's in the catbird seat here as the CRO of a company. I mean, the chief risk officer, and risk management operations overall are critically important. So is internal audit, so is the compliance department, that all needs to stay alert. I mean, one of the issues of managing all of these risks, it's so fast moving. The science is moving, the risk profile is moving quickly, the regulations that are relevant are moving quickly. I saw a risk dashboard for a board presentation just recently, and they had, it's emerging risks, and they're all over. Obviously, they're economic and inflation and others. Climate was there 3 times. One of the climate risks is clearly losses, transition. One of the climate risks for the board is changing regulations, and we see this. And again, I know the IAS, the individual supervisors in many of these countries will attest that the rules are changing very quickly. The reporting requirements are changing very quickly and need to. But the big tricky issue here is harmonization as much as possible, so there's not duplications, that there's some common components of this. But it is a risk. So in any event, it's I think those are the ways that you hardwire it into a company's operation. I'll close very briefly. You said, do we see resistance? Does it bring conflict of goals? Resistance is going to be different company by company. Certainly, I know many where there's not. The issue is, where should we go? Are there still companies where maybe there's a view that, yes, it's a serious problem, but it's not really our problem? Perhaps, but I think the industry is really alive to this. It does certainly create conflicts, and the starkest conflict is in operations, vital economic activities like coal-fired energy for Poland. If you cut it off, people will die. It'll be devastating to a community. On a more micro level, for an insurer that has supported a company, wants to continue to support it, yes, wants to support its transition, you do have, you're juggling goals between pushing the economies into a greener space, but making sure that there's not really severe adverse consequences for people in communities that might be affected by that. So there's some really hard judgment calls that need to be made. I'll stop there.
Okay, thank you very much, Astrid and Bill, for sharing your views on this. I agree with what you have mentioned about the challenges surrounding how to integrate climate risks in the insurance business, given the evolving nature of the risks itself, and also how the public sector and the supervisors are actually, including the supervisors and the regulators, are tackling it. And Bill, I think your point about how to ensure sort of I would say a universal, but a concerted response globally, I think avoiding fragmentation is also very important. In that context, I think the IAIS work would probably be very relevant. But let me now turn over to the public sector side in that regard. And let me first ask Ricardo about what steps you are taking as a supervisor to assess the extent to which climate risk is effectively integrated into the governance and risk management processes at insurers.
This is, I think, a very, first of all, I agree with Bill 100%, but this is a really point of privilege for me to be able to represent our U.S. regulators, where we have really made a big push towards financial disclosure. And, there's no surprise that in the United States, the issue of climate and the issue of climate change is very polarizing, and even to this day. And so the fact that we were able to come together as U.S. regulators in a bipartisan way to start working on requiring TCFD disclosures for US insurance companies in a way that, if you think about 3 years ago, 0 insurance companies in the US had to fill out a TCFD disclosure, and we even created specific insurance questions to add into the disclosure. Now we have 80% of the entire US market having to require these disclosures. And we did it in a way where insurance regulators really came to the table understanding that these climate intensified events don't respect state borders. You know, wildfires don't just stay in California. Floods don't just happen in the South. And so what we are seeing is a tremendous leadership and a point of privilege that I have to say that the NAIC and our members have really stepped up in this matter in a way that we haven't seen before. We again had 0 states requiring it to now 15 to now hopefully up to 26 states next year, which is only going to grow the market share of that. And to top that off, we actually created a Center of Excellence for Catastrophe Modeling that's going to help us as regulators look at what data and what strategies and help us understand what data and the strategies that are being implemented through insurers. Because we also understand that our departments may not have that information. So by really combining all our efforts as state regulators to create the center to help us understand what the future is going to look like and how do we continue to require these disclosures in a way that's uniform, because as you know, Bill just said, we want to make sure that we're not reinventing new things, that we're actually, the data that we're requiring, it's actually going to be useful for us moving forward. And also understanding that some states and some jurisdictions are going to need a larger transition period. Because the fact is, if we start eliminating these co-intensified projects, we're going to put people in danger. And what does that mean, right? And so respecting that we all have our own individual jurisdictions, but then coming together to understand that we need to really start working on what these disclosures look like and make them uniform so that we actually are getting the data that we need, and we're actually utilizing that data to help inform not only our individual markets, but the entire U.S. market.
Okay, thank you. Thank you very much, Commissioner. And let me turn to Daniel, and perhaps, MAS has always been a very sophisticated regulator and supervisor, and perhaps you can share your views on this question.
Yeah, sure. Maybe before I answer the question about MAS, just to pick up a few points of the previous speakers. So, and some reflections after hearing what you said. So, Bill, on what you said about moving forward, there needs to be greater regulatory alignment in the rules and requirements. I think you're absolutely spot on, which is precisely why the CRSG, the IAIS, needs to contribute in this space by setting the tone through the amendments that we hope to consult next year on the ICPs, and then working with our member supervisors to promulgate requirements in their domestic jurisdictions. And Astrid, I was just thinking that just hearing your remarks about the journey Egon is on, I just wish every insurer I regulate in Singapore was a bit more like Egon. So perhaps you can share more of your practices and your 3 lines of defense and what you are doing, and to inspire your peer communities in the rest of the world. So, in Shigeru, on your point about the Monetary Authority of Singapore and what we are trying to do here. So maybe just indulge me a bit, and I'll give you a bit of a sneak peek into how MAS's supervisory thinking on climate risk management in our industry and what we are trying to push for in our industry is like. So at a broad level, our starting point is to support an insurance sector-wide response to climate change. So we see it as a collaborative process with the industry to strengthen the financial system's resilience to environmental risks more broadly, not just climate. And we are doing it in, I would say, broadly 3 steps, right? So firstly, we wanted to first uplift the environmental risk management practices in our insurers. by setting supervisory expectations, and in this case, a set of guidelines and requirements, which we actually co-created with the industry. So these guidelines are sector-specific because we needed it to be practical. So it applies to a separate set for banks, asset managers, and insurers. We wanted it to be principles-based because at this nascent journey that every financial institution is on, there needs to be flexibility in adapting their practices and their risk management controls. And we sprinkle our guidelines with plenty of examples because there needs to be signposts, right? Not just some high-level, fluffy expectation, right? Because then it will be very hard to adhere to, but with a lot of practical examples. And from then on, we published after giving a period of time, some of our most significant banks and insurers, we did a thematic review on-site with them to assess their implementation progress. And we published the findings in what we call an information paper. And this really is to highlight what has been done well, but what are the common challenges that remain to be dealt with. The hope was that through publication of this early stage review, it provides another source of guiding reference on how their peers are managing this risk in practice. So from our review, we found that many insurers have incorporated environmental risk management into their governance structures, such as designating local senior management to oversee climate risk matters, establishing sustainability committees, and I think we've set up a little bit of a cottage industry in identifying CSOs as well. And of course, incorporating climate-related scenarios in their risk assessments through their OSAs. But not everything is good, right? There are areas such as factoring the considerations into their business strategy and underwriting considerations. So this part still remains quite a bit of work in progress. The second step, so we incorporate climate risk into our ongoing supervision of our insurers, right? So how do we do this? The thinking again is that it is and must be an iterative process. So we engage our insurers, as I mentioned, through inspections and dialogues to understand progress at the individual firm level as well as at the industry level. We then utilize the knowledge to benchmark the insurers. We calibrate our own supervisory methodology again, and so that we can perform better risk assessments. And in turn, this allows us to facilitate additional and continued supervisory discussions and share the information and current best practices to strengthen the industry's collective climate resilience. So you can see we do this in quite a bit of a deliberate, iterative way. And furthermore, because MES is an integrated supervisor, we regulate banks and asset managers as well. We are also progressively now taking steps to develop a common baseline across the financial sectors to allow for comparable and consistent assessment, which in turn will help shape our supervisory practices as a regulator. Finally, the third step is that, and this is to me absolutely vital and what Exco Chair Vicky Supporter raised yesterday, we underpin our supervisory approach with climate scenario analysis because we want to better analyze the impact of climate-related risks from both a micro-prudential perspective, but also top-down from a macro-prudential perspective. So I totally see scenario analysis as a key tool to make sense of the uncertainties arising from climate change risks. And this is probably one of the few tools we have to adopt a forward-looking approach in risk management. So earlier this year, the MES, we conducted a climate scenario analysis exercise for selected insurers as part of our 2022, what we call an industry-wide stress test. The exercise was really designed to be exploratory in nature, aim at attuning our insurers to climate risk, and encouraging the development of climate risk management. So, from this exercise, we observed that some insurers have developed new modeling frameworks or refining existing ones in collaboration with external vendors, including using granular risk assessment methods and undertaking scenario expansion over and above the NGFS scenarios, which I think is a great sign and precisely what Bill is saying, that the industry is consciously taking steps to improve itself, and which is a really great sign, great thing from our perspective as a regulator. So in sum, the use of quantitative and qualitative assessments, what Egon has been doing to help us better understand the financial stability implications of climate risk, is also being done at the supervisory level. And this can, over time, inform reviews of our prudential toolkit, as well as our supervisory interventions. Finally, I just want to also make a point on a more forward-looking basis. MAS firmly believes that we as a regulator, but the industry, the insurance industry as a whole, can play a stewardship role to transition towards net zero. So from an MAS perspective, we intend and we need to be able to effectively engage our financial institutions in Singapore on their transition plans and understand how, in this case, an insurer is going to transition their customers towards greater sustainability. So this is something that we will continue to be doing in the coming months and years. I'll stop here.
Okay, thank you very much, Daniel. That presents a very comprehensive, I think, approach on the part of MAS, and I think that's very useful for the audience to know. Okay, our time is quite limited, so let me turn to the final polling question, and this is on protection gaps, which I'm sure that it's very important, not only for us, but also in the private sector as well. And this has been talked in the context of, discussed in the context of a lot of things, including climate. So here, what factors are likely to drive climate protection gaps? And here are 5 choices. And let's look at the answers.
And all of the above.
All the above. Sure, yes. That's true. Okay. Oh, here it's. All right. Can Bill and Astrid look? Do you see these the answers, or because I think it will be worth first hearing your views on this. Is it? Can you, Joe? Can you put the answers on again, just to make sure that? Okay. All right. It's quite actually close. So prices will be too high for consumers, and reduced insurance availability is around the same, followed by not effective, the products will not be effective, or reduction of cover by reinsurance, and consumers do not take up available insurance. So, okay, let me first ask Astrid and Bill about what you think about these responses. Given the time, I think a quick response would be appreciated. Please. Astrid, perhaps you want to go first?
Yeah. So I was very happy to see that this was a multiple choice question because from my perspective, all of these are likely to apply. And in a way that also underlines the importance of timely action, which we've been discussing today.
Okay, thank you. And Bill, what's your view?
Yes, I share Astrid's view, probably everybody's. They are all very relevant. I was a bit surprised about the consumers, that consumers do not take up the coverage was so low, because I think, and we will, I think in the next panel discussion, address this, the reasons for a protection gap. But we know that one of it is lack of trust, lack of understanding, lack of insurance literacy, and that is a big impediment globally to people insuring themselves. And I will say here, Commissioner Lara was talking about the things that California has done. I think they have done an extraordinary job at driving consumer education, letting people understand their risk, what they can do to mitigate it, what products are there, what green insurance products are there. So I'll stop there, but I just, my biggest comment, I guess, is I think the not taking up the insurance is a big issue and has multiple causes.
Great. I fully agree with you, the financial inclusion aspect, the financial literacy aspect. And Bill kindly mentioned about what California is doing in this respect, so let me turn to Commissioner Lau.
All the above. I mean, this is what we're experiencing in California, and but it also showcases the opportunity, especially when it comes to the answer that there's not certain insurance products to meet what's happening, and this is where we're really excited to talk about what the future products are going to look like that insurance must have, so that we're meeting this ongoing change in climate of ours.
Okay, thank you very much. And finally, Daniel, your views?
So the two chosen answers, I thought may not be the first pin to drop, actually. So I'm a bit more pessimistic. I'm really quite concerned that reinsurers will reduce insurance available cover and capacity first, and that triggers a wave. And I hope that I'm going to be wrong, but that's maybe how I think about it.
All right, thank you. So let us move to the specific questions in addressing protection gaps. And first, let me ask Astrid, what work are insurers undertaking to assess how demand for insurance will change as climate risks increase, and to what extent will reducing reinsurer appetite, which was also one of the choices there, for certain nat cat risk increase protection gaps. And so let me pose that question to you. You may want to touch upon some of the international global initiatives that's been going on as well. So Astrid, please.
Yes, thank you very much. Before answering this question, there's one thing I would like to briefly come back from the previous questions. All of you said that harmonization of rules and guidelines is important from your perspective, and I just wanted to say that I was very happy to hear that, because from our perspective that's also important. In a way, I think we don't want to, as insurers, we do not want to spend time trying to figure out how the different frameworks and the different guidelines can be made consistent, or how we can fit our perspective in it, but we just like to move forward. So I think harmonization is a very important topic, and I just wanted to thank you all for bringing that up. But now coming back to this question, so insurers are taking a lot of steps to assess how demand will change. We already see that on the P&C side, of course, where there are more natural catastrophes. I'm from Germany originally, and of course in Germany we had very bad floods last year, and that immediately increased the demand for certain insurance products. And from that perspective, I know that my P&C colleagues are looking into how demand for certain products is changing. But it's not only the case for P&C, also on the life insurance side, which is a bit more relevant for me personally in my current role. There are big changes. On the one hand, people are living much longer, but on the other hand, there is increased uncertainty around how exactly the future will look. And that is also one of the drivers for that is, of course, the uncertainty around climate risk and the uncertainty around the transition and the financial uncertainty that comes with it. So we are factoring this into the way we think about products. And what we are aiming for is really to develop products that can provide financial stability in a life path that may be much less linear than we've seen over the last 20 or 30 or 40 or 50 years. So that's how we are currently thinking about it, and we feel that as insurers we have the responsibility to offer products that address some of the uncertainty that is posed by climate risk.
Thank you, Astrid. I think that's a very important point, especially how to, as Commissioner Lara mentioned about how to make sure that the insurance firms are financially stable from a prudential point of view, but also to kind of realize its role for the society to provide insurance. And I think that's a very important point. So let me now turn to Bill and Daniel. And there's a lot of talk about how to close the gap for protection gap. And there's obviously discussions or conversation about public and private partnerships would be important in this context. So let me hear your views on this, and let me start off with Bill first.
Thank you, Shigeru. I'm mindful of the time, and will try to say a lot in a short period of time. It's a huge topic, a very important one, and there is a lot of activity. First, I think the insurance industry, obviously individual companies are doing a lot, need to do a lot in their individual operations. But I think the industry also has a lot of areas where collective action, collective support is needed, and that many of those also demand engagement and support, quite frankly, from the public sector because of the size of this problem, because of availability, affordability issues, which I'll touch on briefly. But to give some examples of where the industry really has worked collectively, I'm on this panel. You've seen my my title, my role within the Insurance Development Forum. The IDF was formed in 2018. I won't explain it in detail. I think many people are aware of what it is, but if not, I would urge people to go to their website. It's the Insurance Development Forum. It's a public-private partnership. It's insurance industry-led, but with great support from the UN, from the World Bank, and other public sector organizations. It has really worked on a number of things. It is just launching, and a COP will be announced very shortly. Work that's done on a global risk index, trying to address the issue of how do we measure what a country, a city, an individual's risk is, but in a way that is understandable across countries so that everybody is talking about the same thing. In addition, the IDF's risk modeling working group has worked on something that's called the Global Risk Modeling Alliance. This has been a huge effort which is underway to really create open source CAP models and greater access to data. So these are areas where the industry has leaned in with UN, with other public sector players to bring to the table the infrastructure, the tools that are necessary to underwrite risk and then price it and provide coverage. They are also providing work in various programs where you have a public, cover cat bonds for countries that impact people. Let me just take one quick sip of water. Lastly, what will be announced at COP next week is something called the Global Shield Initiative. This is something that's led by the G7 and the V20, the vulnerable 20 countries. It is to create the technical resources and the financial resources to really help emerging and developing economies, the V20 countries in particular, to address climate-related issues. This will come out, you'll see things early next week. Again, in light of the time that's here, I'll just say, stay alert for that, see what is happening. It is a very high-powered initiative that I think will deliver great results. I'll stop there again, just in light of the time, but collective action, collective within the industry, but cooperation with public sector, governments, and others is vitally to address this, the protection. Yeah.
Okay.
Thanks.
Thanks a lot, Bill. And let me turn to Daniel. And in the interest of time, if you can be brief, very helpful.
Yeah, sure. So, thanks, Bill, for raising a couple of industry-level initiatives. So, we are seeing countries come together to address protection gap issues already. So, I think that's the good thing. So, I'll just give you an example from my part of the world. The Southeast Asia Disaster Risk Insurance Facility, or what we call CDRIF for short, was established in 2020, and it's the first regional catastrophe risk facility that provides climate and disaster resilience solutions for ASEAN member states. This initiative is actually led by Japan with the technical support of the World Bank, and it has launched a sovereign flood risk insurance product for Laos to provide post-disaster rapid response financing, and it's based on parametric and finite risk triggers. So these kinds of partnerships allow nation states to uplift the region's climate change readiness and go some way towards addressing some of that protection gaps. So Shigeru, you raised the point about PPPs and what's the role that they can play. In the interest of time, I won't go into all the conceptual details, but I think to me the primary benefit of PPPs is that you can crowd in private financing. And this helps overcome the constraints faced by many governments insofar as from a fiscal point of view. So, and then as you guys know, private-public partnerships are not new. There are numerous examples of cat risk insurance programs designed to help countries absorb the financial consequences of catastrophic events. You have the Turkey's earthquake program, which is operated by a private insurer with financial backing from the public sector. Then you have the Norwegian program, where participating insurers pool funds to pay claims. And then you have Japan's earthquake reinsurance program, which has a loss-sharing arrangement where the government and the industry co-funds losses above a certain threshold. So there are different models out there already in existence. The main point I want to make is that these PPP examples help build financial resilience by providing insurance coverage for risks that have been deemed uninsurable through private markets, but also, very importantly, promote solidarity in terms of loss sharing across regions. A 2021 OECD report found that since 2000, approximately 40% of all economic losses due to floods, storms, and earthquakes in OECD countries was covered by such programs. This is a good progress, but it also suggests more work still needs to be done. So what role does the public sector play? I see the public sector play roles in two broad ways. To me, the lowest hanging fruit that the public sector can play is to ensure collaboration between themselves, academia, and private sector. Ricardo can share on his experience in convening the California Climate Insurance Working Group. Closer to home, we have the Global Asia Insurance Partnership, a tripartite relationship between the industry, regulators, and academia to produce Asia-centric research results and studies, and including on climate change. But I want to turn my attention to a bit of a higher order role that public sectors can play in PPPs. I would break them down into three areas, right? Fundamentally, the public sector can serve as connectors. What do I mean by that? To gather industry, to gather countries, and to gather capital. What do I mean? So, as a connector, the public sector can bring together industry players to find common solutions such as getting into specialized risk pools. So, the IDF, the government of Mexico, UNDP, recently launched a tripartite project in Mexico to develop a sovereign parametric insurance solution for climate-vulnerable small farmers. Next, to gather the countries. The whole point is to gather countries to benefit from lower premiums arising from risk pooling and diversification, and to give them access to global reinsurance capacity. I've already mentioned CDRIF, but the other one of note is the Caribbean Catastrophe Risk Insurance Facility, which is participated by 21 member governments in the Caribbean area. and Central America. Finally, I want to close off with what the governments can also act as connectors to gather capital. To gather capital from different sources through what I call blended finance. Blended finance synergizes public and private capital to mobilize financing for projects that are marginally bankable today. So it combines financing with capacity building, technology transfer, and institutional support to reduce risk and enhance bankability of these underlying projects. So blended finance has the potential to support areas that are today significantly undercapitalized, such as early-stage climate adaptation and mitigation technology, something that Ricardo already mentioned, clean energy access, sustainable transport, and I hope in the years to come, nature-based solutions. So these are the roles that the public sector can play and to complement some of these private sector initiatives that Bill talked about.
Okay, thank you. Thank you very much, Daniel. And Commissioner Lara, if you can talk about the experience in California.
I mean, I think as you were highlighting all the different approaches, really summarizes and what we've been doing in California, where after this I'll be heading to Egypt to also unveil California's first sustainable insurance roadmap, which is the first state or subnational level insurance roadmap in the world, and really focusing on a lot of the strategies that David was talking about, with really our roadmap has 4 strategies that really re-envision insurance and what can this re-envisioning do to promote climate resilience, really through new products, as I mentioned before, sustainable investments, and innovative tools. And so first, I talked already about how we strengthen transparency and financial oversight, which really includes the examples of our bipartisan efforts at NAIC with TCFD disclosures. Second, really in California, we're looking at how do we accelerate transition to more sustainable investment strategies. So for example, in my department, we have created the most exhaustive study and database on insurance company investment related to climate risk, and are really working on evaluating what types of investments and increasing resiliency and really helping us reduce emissions, for example, green bonds. The third is, which I'm really excited about, is how do we catalyze new climate insurance products, right, to reduce emissions and close the protection gaps. For example, we are proposing some innovative climate insurance pilot projects with some blended funding to look at incentivizing investments in nature and how do we cover entire communities around extreme heat, flooding, and wildfires. And fourth, really, again, getting to how do we empower and create resilient communities by reducing risk, through nature-based solutions. There's a wonderful example in Missouri where data quantifies now that actually the nature-based solutions that they had there in terms of help them not only capture some of the floodwater through their watersheds, but actually reduce the price of the cost for insurance for folks. And so again, looking at nature-based solutions at what Mother Nature already has in place to protect us from extreme weather. And how do we use insurance mechanisms to not only restore those watersheds and restore those coastal wetlands and inland wetlands as well, like I said in Missouri, but how do we protect them from future erosion, right? And there's insurance strategies to get us to do that, because the alternative would be this gray infrastructure that not only is unsightly, but it's much more costly to maintain. And so, and really with our roadmap, our plan is to help community and help insurers and regulators not only find solutions for the risk, but how do we communicate that risk? How do we prepare for that risk? And then how do we quantify the risk so that we're all operating under the same amount of data, the same data, so we're not creating additional requirements that are really not going to be representative of what we need as a whole. And so that is an exciting time for us in California. We worked with the UN PSI to develop this roadmap over 3 years, and we'll be proud on the 17th when we announce this achievement for us as a state in Sharm el-Sheikh.
Okay, thank you very much. And I think this concludes the sessions. And I think discussions have been very rich. I'm sorry, the moderator has not been a very good timekeeper, but I would turn to the floor now. I'm sure that given the stimulating discussions, no time for questions. Really? Okay. So that's what I'm told. But thank you very much for that. And let me close off by saying that this is a global issue, too little, too late. But I think there's a role for the public sector and the private sector to play at this initial stage. We're exploring how to deal with it, and I think collaboration between the private and the public sector will be the key moving forward, including how to respond to protection gaps. So thank you very much for all the panelists, and thank you very much for the session. Thank you.